China Global Television Network.
Hello there and welcome to Global Business Africa. We'll be giving you insight into Africa's business and financial markets. I'm Uche Okoronkwo, coming to you from Kenya's capital, Nairobi. Let's start with a look at the markets. Now, three things driving markets today: a drop in a Chinese gaming company Tencent, also worries about the COVID-19 Delta variant, and of course tighter regulations in China. Now, that kept a lid on gains in emerging market stocks today. However, we did see MSCI's index of emerging market shares up 0.2% on the day. It was helped by gains in most Asian bourses, as well as those across emerging Europe, Middle East, and Africa. South Africa's JSE was weaker today. Investors are worried that a major shift is underway in China as it pursues reform. Also, we saw market heavyweight Naspers shares falling as much as 5% today, the most in a week, and that's after Tencent shares finished 7% weaker in Hong Kong. Now, also coming up on the show today, Ethiopia is set to reopen bidding for a second telcom's license in the country. The U.S. reinstates its debt ceiling after a 2-year suspension. And Germany prepares to return African artifacts to the original places they were taken from. Well, tonight we start off in Ethiopia. The country is set to reopen bidding for its second telecoms operator license this month, including the right to operate mobile financial services. Now, this comes after the sale of the first full-service license in May. Ethiopia has a wide potential market with a population of over 100 million. The government is reopening the bid after it awarded Kenya's Safaricom with the first license, citing a lower than expected price for failing to award the second one. Now, under the deal, the International Finance Corporation will serve as the transaction advisor. The government is expecting prospective bidders to include firms which, of course, had expressed interest in the previous attempt to sell that license, but whose bids were deemed to be insufficient. Well, let's get the latest on this from ground. Dr. Eyob Tolina, State Minister for the Ministry of Finance, joins us now in Ethiopia. Great to have you with us today on the show, sir. Now, what we know so far is that this new round of bidding will have a lower than expected price, and also it'll have the right to operate mobile financial services. So what are your expectations for this new round in terms of prospective bidders we could see, such as MTN, which missed out on the last one, and of course the benchmarks put in place this time around?
Thank you so much. As you've rightly indicated, Ethiopia is a big market, more than 100 million people. And in fact, we describe this as the last frontier for the telecom sector. What happened last May is a culmination of what we've been doing over the last 2 years, trying to build a world-class telecom industry, opening up the sector for competition, and also reforming the incumbent Ethiopia Telecom. As you indicated, during the May bid, we had a very strong showing, but we only offered one of the licenses because we felt the second one fell short of our expectation. But this time around, we are reissuing the bid when the council decided in May to only offer one license. There was also a second decision, a decision to immediately commence on the second process, on the bidding process. This time around, we've also made some adjustment where there are some policy changes. For instance, mobile financial services would be included. In the previous bid, we have not included. To do that, we now need to make some legal adjustment. As it stands now, the Ethiopian law, the National Bank cannot allow a foreign operator to operate in mobile services, but now once that law changes, which is in the process of changing, we should be able to offer a new one. So what we expect is a very strong interest from bidders. ECA, the Ethiopian Communication Authority, is in the process of preparing the RFP, working with the IFC, as you have indicated, and we hope to publish this sometime this month, and we expect a strong showing. In fact, I don't know if I mishear you, but we expect actually a much better showing than the second license that we've cancelled in this bid, because we have included a number of incentives, including the mobile finances.
Well, just to clarify, with the inclusion of that mobile money license in this bid, is Ethiopia now considering plans to review a mobile money license to the first consortium, which of course includes Safaricom, which runs one of the most successful payment services in Africa, M-Pesa? Are we going to see a change there?
Absolutely. As you said, Safaricom-backed global consortium that includes big operators around the world, including Vodafone, and financiers from Japan, the US, have won this bid. So what we'll do is, because of this new opening in the policy, the Safaricom-backed consortium would be able to be offered the opportunity to buy a license to operate mobile financial services.
Right. Well, there's also a lot of interest in the state-owned telecom firm, Ethiotel. In June, we know you launched a tendering process for the proposed sell-off of about 40% of the company. Give us some insight into the kind of interest you've seen from that side so far and the prospective investors the country is looking at.
When we've embarked on this reform, we've done this simultaneously while opening up the sector for competition through liberalization. We've also commenced on the process of privatizing Ethiopia Telecom, partial privatization, as you said, a 40% stake. So already during that licensing process, there were global operators that have indicated their interest more into the privatization than a greenfield. So we know there are few operators that are still waiting for this opportunity to open up. So what we are doing currently is we have published expression of interest, and we've seen that a number of global operators are interested in this process. Now the advisory firm and our team are working on the RFQ to be published soon, and we hope to see a very strong interest in the privatization of Ethiopia Telecom. We are offering 40% of the stake. This is a very strong incumbent operator that has been in operation for 125 years. But following Prime Minister Abiy Ahmed's coming to power, this firm, Ethiopia Telecom, has seen momentous reform. It's a completely new company, launched new services, is gaining a big market share. So we know there will be strong interest in this company stake, and we expect this to be concluded in the next few months as well.
Well, on that note, let's talk about Ethio Telecom's mobile money services. We know it launched Telebir, which was the country's first mobile financial services in May. So far, the service has been reported to have attracted about 4 million users within weeks in the country. So give us a sense, what progress is the service making to date? And why the decision to now open up those rights to operate mobile financial services in this second bid, with Ethio Telecom clearly doing so well in the sector?
Yeah, absolutely. I mean, this is one of the strong showings of Ethio Telecom. It's not only on mobile banking, mobile services, but I think in terms of service expansion, they have launched 4G services in many cities over the last few months. Their financial showing is very, very strong. We have a very competent management, and we're really pleased with the pace of the reform of Ethio Telecom. Now, on mobile banking, it's actually astounding. I'm not sure, I don't have the stats with me, but I'm not sure there is a comp that you can point to that managed to attract millions in just a matter of days and weeks. Very phenomenal achievement. So this shows you that the Ethiopian market has huge opportunity. So we're very pleased with that performance. But to your second question, as I've indicated earlier on, we have serious legal limitations in opening up sector for foreign operators, because as it stands now, our law only allows banking services, including mobile banking, financial services, only to domestic operators. But the council last May has decided to also make some amendments in the law. So that is what opened up the opportunity for Safaricom backed consortium for the new license that we are issuing shortly.
Well, a lot going on in the telecom sector. We'll certainly be watching that closely. But let's shift focus slightly and take a look at what's happening in the overall economy. Can you give us an update on the country's economic recovery since the pandemic hit, including those plans to restructure billions of debt as the government seeks to free up funds now to support its economic recovery?
Well, I mean, an interesting question, because we've just concluded the Ethiopian fiscal year. As you know, our fiscal year goes July to June, and the numbers are astounding. I mean, given the difficult year we've had with the COVID and with some challenge in the northern part of Ethiopia, the resilience the Ethiopian economy has showed, and some of the key indicators are very, very encouraging. Let me give you a couple of points. For instance, if you look at our tax performance, we've managed to achieve 20% growth compared to last year. Exports have shown significant performance, 15-17% growth in few months, but at least at the end of the year, about 12% growth. The financial sector showed a strong performance overall, with credits going to the private sector, about 75% credit growth to the private sector. Savings, significant increase. I can go on. I know you probably don't have time, but what this showed is the reforms that Prime Minister Abiy has ushered in, in the economic front, has paid off. Because we've managed to introduce significant economic reforms over the last 2 years, this economy has managed to wither, to stand during these difficult times. In fact, perform much, much better than our peers in the region and elsewhere. So very, very good performance. And looking forward, we expect the economic growth to continue. The projection we have from Ministry of Planning is about 8.5% growth next year. So we expect robust growth. As you know, we've launched our 10 years economic reform prosperity plan, as we call it, a 10-year plan. And this is the first year where we start that plan implementation. But coming to the second leg of your question, as part of that reform, we wanted to make sure that we have sound macroeconomic fundamentals. As part of that, we have made significant macro reforms, including on debt. And as we have initiated a homegrown economic reform program. This reform was supported by the IMF, and as part of that discussion, we have had a number of discussions with our creditors. Where we are now is we are having serious conversations through the G20 common framework, as you know. In fact, we are expecting the creditor committee to be established sometime this month, and we expect significant amount of development finance released through the tree profiling. And this would really give us strong backing for our reform programs and the financial muscle to embark on other sectoral reforms. So overall on debt issue, I think because of good export performance, generally, just for you to understand, Ethiopia's problem is largely on debt service to export ratio. In terms of debt to GDP, we still can even borrow more. But because we have strong export performance now, and we are working on debt treatment, right, we hope we'll be able to achieve a medium level debt distress shortly, and this will give us more room to borrow and invest in the Ethiopian economy.
Well, we do have to leave it there, Dr. Tolina, but thank you so much for those great insights today. That, of course, is Dr. Eyob Tolina, State Minister from Ethiopia's Ministry of Finance. Well, let's move over to Nigeria now, where the fourth consecutive year the economy has seen a major reduction in its capital importation inflow. Now, a recent report shows that Nigeria recorded a decline in capital importation by 54% in the second quarter of this year, and that has further piled pressure on Africa's largest economy. Here's Deji Badmus with the details.
The capital importation report is a clear indication that more than a year since Nigeria exited its last recession, Africa's biggest economy is still struggling for foreign investors' confidence, and recovery is still slow. In the first quarter of 2021, the country attracted $1.9 billion. The second quarter figure of $875.6 million is among the worst in recent times, with foreign portfolio investments alone accounting for 63% of the figure.
So it's a pretty much complicated situation that we have right now compared to where we were, first half of 2021. Our recovery process is still very much weak, compared to the 16-17 recession. And also the fact that the year so far has been filled with a lot of fiscal indecisions in the sense, conversations around the revenue crisis, conversations around the insecurity challenges and how it's impacting on inflation and further stretching the value of the currency. And so when we put all these things together into context, it will simply speaks to the fact that there is a great lack of clarity in the Nigerian economy right now, and that's impacting on investors' confidence.
The report shows the United Kingdom continues to top the source of capital investments in Nigeria, accounting for 35% of the total capital inflow. While the banking sector accounted for the bulk of the inflow, 89% of the capital investments ended up in Lagos, the country's commercial capital.
We've not also done the hard work of ensuring that FDIs and capital investments are properly spread across different sectors to unlock value chain relevance and to grow the potential of returns and all that. And that's also depending on the fact that we've not appropriately locked the potential of those sectors, and linking them up to more market-focused opportunities and exploring market value in that space. Until there's a form of market value, investors will not see the need to invest in a particular sector. And as there's a form of an enabling environment, when it talks about security and all of that, it's also the same thing. Investors will not see any incentives to invest.
The struggle to attract foreign capital inflow is telling on the country's reserve, and by extension, the local currency, which has been coming under increasing pressure in the last 1 year.
But what we have noticed is that because of the dwindling foreign reserve that we are experiencing in the country, that CBN has not been able to meet up with the demand of this foreign investor anytime they want to leave the country. So because of that, some of them are trapped in the country. They've not been able to repatriate their fund back to their destination. So because of that, they've been skeptical in bringing fresh funds into the system lately.
The last time Nigeria had a major break in its capital importation inflow was in 2017. But 4 years after, the country is yet to see another rise, indicating a significant drop in investors' confidence in the nation's economy. The insecurity challenge in some parts of the country has also not helped matters at all. Deji Badmus, CGTN, Lagos, Nigeria.
And now let's take a look at our corporate headlines today. South Africa's Eskom Holdings is seeking to appoint advisors on how to restructure itself into 3 separate units. The reorganization plan will see the power utility separated into transmission, generation and distribution units. Now, this was proposed to allow for Eskom to better deal with its almost $28 billion debt. And telecom's giant MTN Nigeria has concluded plans to invest $1.5 billion over the next 3 years to expand its broadband access. This move by the company is seen as part of its plans to help boost its 4G coverage and provide home broadband, which will be part of a rural connectivity program. And East African Breweries is confident that it will restart dividend payouts this financial year. because of higher beer and spirit prices in a period when unit sales are expected to rise. Now, the brewers' profit margin is expected to recover from the effects of COVID-19, helping to reverse a freeze on dividends that followed flat earnings. The firm last paid an interim dividend of $21.8 million for the 6 months ending December 2019. And PepsiCo is to sell Tropicana, Naked and other juice brands to French private equity firm PAI Partners for about $3.3 billion. The U.S. drink giant will retain a 39% non-controlling interest in a new holding company for the brands and has also granted PAI an irrevocable option to buy certain juice businesses in Europe. And that is a look at our corporate headlines. Well, we are heading into a short break now, but still coming up on the show. Ride-hailing service Bolt raises more than $700 million. And South Africa's Durban harbour is back in business after its IT system was hacked.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business, only on CGTN.
Every story starts out like this.
Okay, we'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible? And why?
Let's get some reaction on ground. Joining us in Johannesburg is Sutra Naidu. Hello, Nairobi.
This is how all stories begin. See how they end. Only on Global Business.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home, and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN, see the difference.
Africa is the nexus of enterprise, and Global Business will tell you why it matters.
From the mega investment projects to multi-billion-dollar mergers and acquisitions.
Africa today collects, just in terms of revenues for taxes alone, $545 billion a year. If you take 10% of that and you devote it to the energy sector, problem solved.
All this on Global Business, weekdays at this time on CGTN.
Welcome back. Now, ride-hailing service Bolt has raised more than $700 million, increasing the company's valuation to more than $5.5 billion. Now, Bolt will use those funds to accelerate the expansion of its existing mobility and delivery products across its African and European markets. These include investments towards enhancing safety features on the platform for drivers and riders, as well as driver and courier empowerment. Now, Bolt will also use the funds to boost its new under 15-minute grocery delivery service called Bolt Market that was recently launched in Europe. Well, joining us with more insights into the firm's African plans is Paddy Patridge. He is Bolt's Regional Director for Africa and the Middle East. Great to have you with us today, Mr. Patridge. Now, this is certainly quite a significant capital injection for the firm. One, you say, as we mentioned, will be used to accelerate the expansion of all your services, not just mobility, but also delivery products in a number of African markets, we expect. So give us a sense, what will that expansion look like? Where specifically will we see you channel those investments in the coming year?
Hi, Uche. Great to be here. Thanks for having me on. As you say, I mean, we're looking to use this very significant capital raise to expand both geographically within our core regions of Europe and Africa, and then also to expand some of our newer verticals. So as you mentioned, we recently launched car sharing. We also recently launched Bolt Market, our 15-minute grocery delivery service. Both of these have been launched in Europe. And certainly over the next sort of 6 months or so, the core focus is expanding further in Europe, but certainly we'd be looking to bring Bolt Market to Africa next year. I think in terms of sort of how we plan to use the funds for expansion within Africa, we recently in this year launched Bolt Food in several markets, so Kenya, Nigeria, Ghana. We've already been up and running in South Africa, and we're very much looking to build out that service within the geographies we've launched and potentially into new markets. Our ride-hailing service, we're currently in 7 markets in Africa, Nigeria, Ghana, South Africa, Tanzania, Kenya, Uganda, and Tunisia. And we're very much looking to expand within these markets. So, I mean, our strategy is very much, it's not just to go into the capital city, it's very much to expand into all the cities we believe are viable. So in Nigeria, for example, we're in close to 30 cities, and that's our strategy, and we want to continue doing that. Similarly, we are looking at a number of new markets within Africa, within North Africa, and within the Middle East. So markets where we believe there's a big opportunity in terms of high urban density, high smartphone penetration, an opportunity in terms of being able to improve mobility and food delivery in these markets. So yeah, you'll definitely see us launching a few new markets, hopefully over the next sort of 6 to 9 months.
All right. Well, let's delve further into that. Looking at recent comments from your CEO, he says in the last 18 months, Bolt has become a very different company. You're also looking to fashion yourself as a super app with multiple services touching different industries going forward. So give us a sense of how we will see this impact your current model, especially on the continent going forward.
Yeah, so I mean, our core business, and I mean, it's still obviously our largest business by volumes by some way, is our ride-hailing business. So I mean, that's in Europe, it's primarily cars. In Africa, it's cars, motorbikes, and three-wheelers. Particularly motorbikes is big business for us in East Africa, and that's been our core business. Our mission generally is to provide sort of the most efficient and most affordable mode of transport for the different types of trips you would want to do on a day-to-day basis. And obviously cars, potentially motorbikes, only solves part of that problem. So we are looking, and in Europe, for example, we've become the largest micro-mobility player this year. We're looking to find more economical modes of transport for those short trips that you can be taking individually. So, I mean, as I say, scooters, bicycles, those forms of transport. We're also looking to find more affordable solutions for the longer trips, hence why we've launched the car sharing service in Europe. So these are the ways we're trying to cover the mobility topic. And then we're also, as I say, trying to build out the service as a one-stop shop, not just for mobility, but also for delivery. So food delivery, and then delivery of sort of core groceries under 15 minutes. And so we want this to be the single sort of the one-stop solution for mobility and for delivery. In Africa, I think some of these solutions will take a little bit more time to be rolling out in our markets. At the moment, we have, as I mentioned earlier, we have the ride-hailing and the food delivery. But I'd very much like to roll out some of the micro-mobility solutions in certain areas of some of our markets, and similarly the bulk market service as well next year in some of the markets where we've seen highest adoption of ride-hailing and of food delivery. So I think, I mean, certainly going into next year, I think we can start seeing that vision of being a one-stop shop for mobility and delivery start to really materialize in Africa as well as we've been able to do in Europe.
Right. We're certainly keen to see what that will look like. But looking at the company's bottom line going forward, we know Bolt was hit hard with a severe drop in revenues early in the COVID-19 pandemic. But you say now you're experiencing hypergrowth in the past year, growing your customer base to 75 million globally. So what did that rebound look like for you? How did it impact the business moving forward?
Yeah, so I mean, I think obviously, like pretty much all businesses globally, it had a pretty material impact. I think we were quite lucky in that, for a lot of our regions, the impact was quite short term. Particularly, I think if we look in Africa, there was a very painful month or two where volumes dropped materially, but then in several of our markets, we were actually able to rebound better than pre-COVID, actually fairly quickly. So markets like Ghana, we were surpassing our pre-COVID levels within sort of 3-4 months of the worst of the COVID situation. Similarly, in markets like Tanzania, we saw very sustained strong growth. And even in markets that have been worse hit and had tighter restrictions like South Africa and Kenya, I mean, we're still beyond our pre-COVID levels. And then in Europe and also in Africa, I mean, I think something we really tried to do to mitigate the impact of COVID was to launch and invest more in verticals that were more sort of COVID resilient. So particularly around things like food delivery and now obviously the bulk market, so services that have actually had a big growth during COVID. So what it means is, as a business, I mean, we've actually, aside from that fairly intense but fairly brief dip, we've actually had fairly good growth. And then what I think was also great for Bolt is, whereas a lot of companies had to lay off a lot of employees, unfortunately, thankfully in Bolt's case we didn't. So we made sure there were no layoffs. And instead, I mean, what you've probably seen is that we're now actually in a phase where we're recruiting very aggressively. I think we have around 500 new positions out, looking for people to join the Bolt journey. So I think, yeah, as a business, we've proven to be pretty resilient in the face of COVID.
Well, we do have to leave it there, but thank you so much, Mr. Patridge, for giving us your insight into the company there. That was Paddy Patridge, Bolt's Regional Director for Africa and Middle East. Now let's move on. The rise in South African producer price inflation does not bode well for the overall domestic inflation outlook. Producers are passing on their costs to consumers in the country, who of course are already under financial strain. Here's Angelo Coppola with more.
Producer inflation unexpectedly jumped to 7.7% year-on-year in June from an already elevated 7.4% in May. One area feeling the pressure is the metals and engineering sector.
One of the key major input costs into the metals and engineering sector from the production point of view, it's actually coming from the mining sector. And then on average, for the last 6 months to June, we've seen prices in the mining sector products actually increasing by, on average, 17%. So that is quite concerning for us because it's putting pressure in terms of profit margins from the industry point of view.
As South Africa comes to terms with the economic costs of the arson and looting, the impact was very clearly on supply chains.
It had a little bit of disruptions, but I think we are glad that there's some normality which is returning and the security has been beefed up. So in the next 3 months or so, I think we'll see a proper return in terms of production patterns.
The short-term prospects for producer inflation are not optimistic, according to analysts.
I think with the oil prices going up and commodity prices going up, and along with internal problems like electricity, supply shortages, and disruptions, it's very likely to increase beyond 8.5–9%. At the moment, we're on the highest level that we've been in 7 years. It's very likely that we'll pass the 8.5% mark, and once we do that, it'll be the highest in 10 years.
This isn't good news for consumers in the short term.
It's going to be very difficult for the Reserve Bank to maintain interest rates this low in this environment. I think there'll be another Monetary Policy Committee meeting where we will get away without a rate cut, but the one in about 4 months' time will be very difficult for them not to give a rate increase, purely because the inflation and the PPI are now both well above the repo rate, and in fact one of them is above the actual prime rate.
Analysts are concerned about the sustained and elevated food and petroleum-related product price inflation, which they say poses upside pressure on headline producer inflation. I'm Angelo Coppola for CGTN in Johannesburg, South Africa.
Well, still in South Africa, the Durban harbour has opened for business. The main port facility run by state-owned Transnet was under force majeure for a week after its IT system was hacked. Now, all systems have been restored, but the hard work to clear a massive backlog is now underway. The country's recent rioting and looting had already caused a break in the supply chain. Getting critical food lines into the stores is being prioritized. Here's Sumitra Naidu with more.
The Durban harbour is the largest port terminal in sub-Saharan Africa. It's also the busiest terminal on the continent, with over 31 million tons of cargo moving through it annually. The alleged cyber attack brought all movement to a standstill. Now Transnet is in a rush to move containers with perishable goods.
The Transnet system has been restored after the cyber attack. We still have over 400 reefer containers in Durban that we need to move out of the port within the next couple of days. Obviously today that work all starts, and the importers are now working with manufacturers, with the port services, with the Department of Agriculture's veterinarians to now enact that.
Authorities were more concerned as the attack occurred as the civil unrest was slowly dissipating, but government backed away from linking the cyber attack to the insurrection. South Africa's processed meat sector relies heavily on imported ingredients. The SA Meat Association says much of this product is destined for inland producers who employ thousands and feed millions of South Africans.
We have 2 manufacturing operations in Durban which have been severely damaged by the rioting and the looting. Both of those facilities are going to take quite a while to get back into production because they are physically damaged, burnt. One is significantly damaged and may take as much as 12 months to get back into production. But what also transpired is that there were 4 cold storage facilities in Durban that were significantly damaged.
In May, prior to the unrest, 16,000 tons of raw meat material was imported to South Africa, 75% of which came to the country via the Durban port.
MDM, the biggest raw material that we import, is predominantly used in what we call emulsion products. So Vienna's, polonium, and Russian are the typical examples of those. And they're a very significant protein for the less affluent communities of South Africa. And they are really large volumes that get used in South Africa, get produced. So we import about 16 to 18,000 tons a month of MDM.
Given the disruption to the retail supply chains, producers have had to ramp up their orders to replace what was lost in the value chain. Port authorities are also working around the clock to ensure these food supplies are delivered soon. Sumitra Naidu, CGTN, Johannesburg, South Africa.
It's just taken me completely out of my depth, but at the same time it's exciting. It's new, it's different, it's a challenge.
It's really exciting.
How will your world change today? What happens here? What happens there? Or what do you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
I try to not let it affect me, but there are days when it does. I'm a human being, and to see patients in a hospital bed and their family members are not there, there's no one there to hold their hand, that human touch, you know?
I just hope everyone can remember that the situation is not permanent and that everything will get better eventually.
Welcome back, and now to some international news. A legal limit on how much debt the United States government can owe is now back in force. This comes after a 2-year suspension on the debt ceiling lapsed over the weekend. Now, the Treasury Department says it will now take emergency measures to conserve money to avoid breaching the federal borrowing limit. Here's Sarah Walton reporting.
The US debt ceiling that the federal government is authorised to borrow was set in 2019 at $22 trillion. That expired on Sunday, and it now adjusts to the current level of debt, which was more than $28 trillion at the end of June. The Treasury Department says it's going to use what it calls extraordinary measures to make sure the US doesn't break that new borrowing limit. Options include prematurely redeeming bonds held in federal employee retirement savings accounts and then replacing them with interest later on. And it can stop contributions to certain government pension funds. And with that, the Treasury says it should be able to stave off hitting the debt limit until October or November time. So essentially, the clock is now ticking for Congress to reach a deal to extend the debt limit or suspend it again. And if it doesn't, it'll run out of cash and default on financial obligations. So it wouldn't be able to pay social security payments or salaries for federal employees. It couldn't even pay its utility bills. If that happened, economists say it would be disastrous for the US economy, causing interest rates to spike. It would also disrupt global financial markets, which depend on economic and political stability in the US. Now, the US has never defaulted, but even the threat of that happening could be enough to have a negative impact. Now, so far, congressional lawmakers have not outlined a path forward in order to avoid a potential default later this year. But Democrats have just a slim majority, so they need a bipartisan deal to avoid a filibuster in the Senate. Republicans have said that's not going to happen unless Democrats agree to a series of debt-reducing measures. Democrats say tying that to a debt ceiling increase is like holding the financial system hostage. Without help from Republicans, Democrats would have to pass the increase through a budget reconciliation measure, which only needs a simple majority. But Democrats are already planning to do that to pass their 2022 budget resolution, and it's not clear if the Senate parliamentarian would allow them to proceed with 2 reconciliation votes. Sarah Walton, CGTN, New York.
Now, Spain recently came out with a legislation to protect the rights of gig economy workers, such as delivery riders or online car hailing drivers who have been working hard during the COVID-19 pandemic. Though the move has generated a lot of controversy, the government is determined to press ahead with its efforts. CGTN's Rahul Patak has more on the gig economy and its impact in Spain.
It's lunchtime in Madrid, and Glovo rider Julio Cesar is on the move.
Julio is one of Glovo's 13,000 food delivery riders based in Spain. The work is hard, the hours are long, and during the height of the pandemic, it carried a high element of risk to their health. But throughout the lockdown, the riders were out on the streets delivering food, whilst the public were confined to their homes. Now, the Spanish government says it wants to protect the rights of these food delivery riders, so they've announced a plan that will make them employees of companies like Deliveroo, Uber Eats and Glovo, and that'll mean they'll be entitled to things like paid holidays and sick pay. It will mean extra costs for the delivery companies, and for riders like Julio, those extra costs will eventually affect him and his fellow riders.
It
will affect our incomes for sure. We'll be having extensive shifts, but we won't see the effect of that in our payroll. We'll work more and earn less for sure. That's why I say this will slow us down.
Spain's ruling socialist coalition says the legislation, the first of its kind in the EU, is designed to crack down on the so-called gig economy, which relies on hundreds of thousands of independent workers for app-based services such as food delivery or car rides.
The government has a strict way of looking at this. They're not open to listening, working with the platforms and finding a solution, which for us is looking for a way of maintaining flexibilities, but giving the workers more social rights.
The status of those working in the so-called gig economy is a question that's being discussed all over Europe and not just in Spain. Britain's Supreme Court ruling that Uber drivers were workers and not independent contractors.
It looks like there will be a domino effect, and shortly other countries in the EU will make the similar decisions as the ones made by the Spanish government, with the council and support of the unions.
For riders like Julio, even though they welcome the extra job security the new legislation is supposed to give them, many will be reluctant to lose the freedom and flexibility that they currently enjoy. Rahul Pathak, CGTN, Madrid.
Now, from recycled metals to cardboard beds, Tokyo 2020 is aiming to become the greenest Olympics ever. Organizers have pledged that the Games will emit net zero carbon emissions. But is it eco-friendly enough? Mayu Yoshida takes a look.
This factory on Tokyo Bay processes dozens of tons of plastic bottles every single day, including all bottles from the Olympic Athletes' Village. The bottles are pulverized and heated before they're turned into plastic bottles again.
For a long time, Japan exported its waste, but it's important to circulate waste domestically and recycle what we can at home.
Organizers want to make recycling and sustainability key at the Tokyo Olympics. Over 6 million electronic devices have been donated and turned into 5,000 Olympic medals. The company that spearheaded the project says the pandemic helped them collect more devices.
As more people stayed at home, they started cleaning up their house, and that led them to donating unwanted computers and smartphones.
At the Olympic Athletes' Village, sustainability is being promoted at every corner of the village. Here at the Olympic and Paralympic Village, thousands of athletes from more than 200 countries will be living here. They will be using recyclable beds and partition walls and will be riding electric cars. The village will also be powered by hydrogen. The hope is for this to be a new model for sustainable inner-city housing. But despite all these efforts, some critics say it's far from reality.
The eco-friendly efforts at the Tokyo Olympics have highlighted the double standards of Japan.
The standards, critics say, were created just for the Olympics. Japan is still the second largest generator of plastic waste per capita in the world, according to the United Nations Environment Program. Olympic organizers hope the Tokyo Games will leave a lasting legacy on not just the competition, but also the environment. But whether Japan can keep its sustainability pledge after the Olympics will be in the hands of the people. Mayu Yoshida for CGTN, Tokyo.
Well, on that note, let's take a look at commodity markets today. Oil prices falling in volatile trading as concern over rising cases of the Delta coronavirus variant weighed on prices, while of course expectations of lower U.S. inventories lent some support. Both benchmarks, Brent crude and WTI, had risen more than 60 cents earlier in the session. Also, despite recent fluctuations, Brent has risen more than 40% this year so far. Meanwhile, gold prices inching lower today as investors avoided taking big positions ahead of U.S. jobs data, which is due later this week. Of course, that data will be an important parameter to determine the U.S. Fed's future policy stance. And on that note, let's take a short break, still coming up. Germany prepares to return African artifacts to the original places they were taken from.
Africa is a continent of diversity, with varied climates and enchanting geography, and a people so distinct, but with a shared enduring spirit. We are at the heart of the continent to bring you the untold stories.
Let's have a look.
We celebrate Africa as it shapes its own destiny.
Tunis, Cairo, Juba, Johannesburg, Ethiopia, Tanzania.
Africa Live. Find your voice.
Images may appear to be identical, but looks can be deceiving. The difference is not always obvious. It has to be discovered. There are always different sides to a story. We put the focus on the details. To see more, to understand better. CGTN. See the difference.
The greatest journeys, the greatest sights, the greatest adventures.
Here in Panater, this weir allows the locals to walk on water.
We're far more than just TV news. We're your passport to the wonders of Africa.
To bring you stories of struggle, survival and hope.
So let's explore. CGTN. See the difference.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about. CGTN, see the difference.
Now, for some, they are rare artwork, centerpieces of Europe's biggest museums, and for others, they are painful reminders of colonialism and exploitation. Now, Germany has become the latest country to return precious antiquities to the original places they were taken from. Here's Trent Murray reporting from Berlin.
Well, this is the Humboldt Forum, an $800 million museum which has just opened here in the historic center of Berlin. But this colossal project has been controversial on several fronts. Firstly, it sits on the site of the former East German Parliament, which was demolished to make way for this new project. And as for the design, well, You could be mistaken for thinking that this is a seat of power for some sort of royal family. And that's because the building largely is a replica of a Prussian palace which sat here for hundreds of years before being lost to Allied bombing in World War II. But it's what was meant to be inside this place that's become the real flashpoint, particularly for Germany's relations with Africa. The museum had planned to display the Benin bronzes, ancient sculptures that once decorated the former Kingdom of Benin, an area which is now southern Nigeria. But that, as you might imagine, has been hugely controversial. That's because the artefacts were stolen by British soldiers in the late 19th century, brought back to Europe and then sold off to various European and North American museums. And while Germany has held on to theirs ever since, activists have long said it's time to give them back. Despite some initial pushback, years of campaigning and calls between Abuja and Berlin has paid off and has finally seen an agreement on restitution of the ancient antiquities. Authorities here say the official restitution process will begin next year, and it is expected that some of the sculptures will be housed in a new museum in Benin City. But there are questions about whether the whole collection will be sent home or just a few items. But it still is a significant step, one for Germany in particular, who's been forced to confront its role in colonialism and exploitation, as well as for other countries, including the UK, as pressure builds on them to return the ancient relics to their rightful home. Trent Murray, CGTN, Berlin.
And before we leave you today, a quick look at Africa's currencies. South Africa's rand firming up early on Tuesday. It hovered near two-week highs hit in the previous session, boosted by commodity prices and a weakening of the dollar. It, of course, extended gains made last week after a dovish tone from the US Fed meeting. Meanwhile, Nigeria's naira continues to hover around 411 naira to the dollar at the official window. However, it strengthened at the parallel market, closing at around 512 naira per dollar. That's after trading at around 515 the previous day. Now, the recovery is coming as the deposit money banks start to implement the CBN's directive on forex, in addition to competing to meet dollar demand in the country. Well, that's it for this edition of Global Business Africa. Remember, you can send your feedback to the contacts on your screen. You can also follow us on our various digital media platforms. From me, Uche Okoronkwo, and the rest of the team, thanks for watching.